Welcome back to the StockTA podcast. I'm your host, Kevin Stewart. Today, we're looking at a roll-up story that is moving at an incredible pace. We're talking about Elevate Service Group, ticker SERV. Please note this interview is being disseminated on behalf of Elevate Service Group. While most people see facility management as a fragmented local business, Elevate is modernizing it into a national tech-enabled platform. They just announced a transformational acquisition of TFI Food Equipment Solutions, nearly doubling their revenue overnight and creating a powerhouse in the commercial kitchen and national retail space. To walk us through the growth engine and the 2026 roadmap, I'm joined by Elevate CEO and Director, Paul Bissett. Paul, you've taken the company from a public listing to a $90 million run rate in record time. Thanks for being here.
Thanks, Kevin. Appreciate the time to speak with you and your audience. I'm just going to share my screen here and we can run the audience through a few pages.
That sounds good.
So look, Elevate Service Group, we're publicly traded on the TSX Venture, and we've also got a listing on the Frankfurt Exchange, and we're underway getting our US OTC listing. So our strategy is to consolidate and modernize the facility services sector through a buy and build model. So that means acquisitions, organic growth, integration, and cross-selling, with the overall objective of providing national commercial customers with a single trusted source for all of their facility maintenance needs. As you mentioned, we went public in November of 2025 at a $1 per share stock price. We raised about 10 million of equity in that time. And since then, after completing our first platform acquisitions, we've completed 4 additional transactions and effectively tripled the revenue base of the company in just 6 months. So the run rate revenue of the business right now is approximately 90 million with all of the transactions and acquisitions we have under our belt. We operate at about a 33% gross margin and pro forma about a 12% EBITDA margin. We've been fortunate to acquire some fantastic companies with great operators on attractive terms, as demonstrated by some of the metrics that you'll see. Our customers are a highly diversified group of blue chip brand name customers, quick service restaurants, retail, and other commercial clients. Like I said, focused on multi-location national clients. And our integration strategy is to leverage a centralized technology and dispatch platform to offer what we describe as the one call strategy for the entire portfolio of services, from plumbing, electrical, handyman, food service equipment, and so on. And we've come a long way, but we're really just getting started here. And we see this as a multi-$100 million opportunity in the short term, with multiple levers for growth being additional acquisitions and driving profitability. Just quickly on our services, currently under our current portfolio, we provide licensed plumbing services, electrical, food service equipment, general maintenance and renovations, and we wrap it all up with a data and analytics suite to give KPI metrics to ourselves and also the customers, so they understand that we're operating with their best intentions in mind. We do that primarily with an in-house team of technicians. So we're effectively what's known as self-performing in the industry. And like I said, our strategy is to provide a single point of contact for these commercial clients to satisfy all of their facility needs. In terms of our platform, we're right now a Canadian-focused business, although we do see opportunities to grow in the US, but we're coast to coast, effectively in all provinces and territories of Canada. We have 130 internal technicians under our portfolio, licensed electricians, plumbers, handymen, food service, equipment personnel, and so on. We do utilize subcontractors in key markets where needed, but we seek to grow that internal technician base. It's a higher margin when you have your own technicians. It's better service, more consistent service for the customer. And our goal is to provide the same service in downtown Toronto as you would receive in remote Canadian markets, which is very important for these national chains that operate in all markets across Canada. We're based in the GTA, Greater Toronto Area, and we've got offices across the country. In terms of our M&A strategy, it's really focused on rolling up this fragmented industry, adding complementary services so we can provide a broader portfolio of services to the customers, onboarding more in-house technicians, and getting deeper regional coverage. You can see the transactions that we've completed here to date since going public in November of 2025 on attractive multiples, generally 1.5 to 2 times EBITDA, up to 3.5, 4 times EBITDA, in structures that are very favorable to the company, but also favorable to the vendor by taking some cash off the table and then rolling into a stock with a portion of the consideration. We're able to bring these leaders of the companies up into Elevate and incentivize them, align them for the long term. Just to double click on the TFI acquisition that we completed in May of 2026, this was really a transformational acquisition for the company. This is a 70-year-old business in food equipment distribution and service. You can see a few of the customers there. They work with all the major brands. They've got exclusive distribution rights for the equipment for Taylor, Henny Penny, and Frankie, three of the leading food service manufacturing equipment companies in the world. So they've got exclusive distribution for those companies in Ontario and Atlantic Canada. And they're really a trusted partner. If you think about mission critical services and equipment for food service, it's all about the revenue generating assets, the ice cream machines, the grills, the fryers, and so on. So they've built over their many decades in business a really trusted relationship with these brands. And with this company, not only did we add 40 million of top line revenues to the business, we added a captive customer base that is highly trusted. And the opportunity for us is to cross-sell all of our other services into these fantastic customers and develop that one-call strategy. So on this page, you see just a selection of some of the broader customers across the whole portfolio. And as you can see, right now, we provide generally 1 to 2 service lines per customer. And through these cross-selling initiatives, our strategy is to get that up to 3 to 4. So like I said, getting more of the customers' kind of share of wallet, getting deeper embedded relationships, and most importantly, why we're in business is solving a problem for the customer, which is to offload that facility maintenance headache, provide one call for multiple services, one trusted partner with a robust technology platform, reporting, KPIs, first time fix, and a level of sophistication that you're not going to get with these regional players in this fragmented industry. Like I said, we're investing heavily in technology. One of those aspects is a geointelligence mapping platform. This is just kind of a snapshot, but it's a dynamic database mapping software that tracks all of our customer locations with all the relevant data, number of service calls, key pain points for that location, all of our company assets and resources, technicians, and so on. So using this on a daily basis to drive, intelligent decision making, and using this as well to help underwrite future acquisitions, understanding where we have gaps in the market, where we're paying too much overtime, too reliant on subcontractors, is really a game changer for us as we kind of develop this portfolio and platform and seek to grow further. Just to give you a snapshot of the financials, so you can see we're now a very well diversified business in just 6 months, roughly 90 million of top line revenue, 12% pro forma EBITDA margins, over 25 recurring blue chip customers. And you can see by product type, approximately 30% product, which is primarily the equipment distribution and lighting products, and then 70% service. By service line, it's equipment service, plumbing, and electrical are the top 3. And you can see by customer, we're diversified as well, and we'll look to diversify further as we unlock that cross-selling of all the services across the platform. On the organization, so I helped found this company with a number of other partners and effectively took the CEO post in November of 2025 once we officially went public. My background is in primarily capital markets, mergers and acquisitions, business advisory, and consulting. I was a senior managing director at an investment bank for 10 years. And we've got a great team of personnel with me. Frank, who's our CFO, very experienced and capable CFO. And like I said, through these acquisitions, we've been able to recruit and onboard talent into the company. So for example, Michael Chung, who is the president of TFI, is leading all of the sales and business development for the entire portfolio. Robert Whiteside, who was the president of Think Green Solutions, is now our head of operations and integration. And Gary Relino, who came with the first acquisition to go public, is a senior client management executive for us as well. Just on the board, the chairman of the board, he's really executive chairman because he's very active day to day in the business, is Romeo Di Battista Jr. He's also the biggest shareholder. He's got a family office that he runs, which is the biggest shareholder in the company. And he's very active in negotiations, origination, and day-to-day operations of the company. And then Aaron Unger and Sebastian Quetchley both have credible backgrounds, and they're the independent directors. And then lastly, just on the capitalization structure, about an $80 million market capitalization, 36.5 million shares outstanding. One thing to point out is that just after going public, we had, probably 33 million shares outstanding. So we've been able to effectively triple the company with very, very little dilution to the common shareholders, which I think is something we're proud of. On the leverage side, we've got about $15 million of senior debt, which is about 1.5 times senior debt to EBITDA, so quite conservative. Our lender is a Schedule 1 Canadian bank. We've got a great relationship with them. Additionally, we have $10 million of subordinated promissory notes that PIK interest and mature generally 3 years. The interest rates are 2, 3, 4% in that range, so very attractive. And we've got a $6 million undrawn revolving credit facility that we'll look to use to support working capital and other acquisitions. And then just on the ownership, like I mentioned, Westmount Park is the biggest shareholder at 30%, about 20% through other partners, management, and the acquisition vendors of the groups we've acquired. And then you've got the other float at 44%, but I'll just point out, even within that 44%, it's very tightly held with strategic investors that came into us with the first capital raise when going public. And so we know where that stock is, and it's very tightly held, which is why we've been able to have a supportive investor base. And about 75% of all the common shares are locked up for at least a couple of years, providing good alignment with new investors. So that kind of concludes the presentation, and I'll just bring it back to you, Kevin.
Yeah, thanks for walking us through. So I was going to ask about your background, and the M&A part makes a lot of sense, but how are you able to not only negotiate but close so many of these deals so quickly?
Yeah, I would say we've got a lot of great team members that can wear a lot of hats. So, as an investment banker at a boutique firm, I was at Stifel and G&P Securities before that. I had a pretty dynamic role wearing multiple hats and developing multiple skills. Romeo was very active in these negotiations and closing, and then relying on a great team of advisors and service partners to get it done. Ultimately, the vendors that we had join the company really saw the Elevate vision. I think if you think about the story and the consolidation and investing in service-based businesses, it's something that's very easy to understand and underwrite. And when you think about the power of combining all these companies together, certainly the sum is greater than the individual parts. So getting the vendors to kind of buy in, take back some stock, and then contribute towards the growth going forward.
I really like that slide where you gave the background on how you've had different people come into the companies through these acquisitions. How has that been a value add just to have that expertise in house? I mean, basically you're buying those businesses, but you're still having the people who know them better than anyone else still working for you to help integrate everything and make sure it runs smoothly. What's the value add there?
Yeah, look, that was essential for us, especially in these first kind of fundamental kind of formational transactions, right? So we're a lean team, which is why we like to keep the overheads and the cost low. But I think, finding great people, we're fortunate with the acquisitions that we found, and we picked those deals for a reason. We didn't really just cash out owners and founders completely. The pipeline of transactions is, dozens and dozens of deals, but we were able to pick the ones where we could find the right leaders for the company. And instead of recruiting and, having to, pay big salaries or big kind of, incentive packages, we were able to onboard these people, incentivize them uniquely, but then also bring them up to a leadership level inside of Elevate.
No, that's great. I mean, and now, they're aligned with the Elevate, like your success will be their success, because if they have shares in it, they want to see you guys continue to grow while still limiting dilution, because they don't want to dilute themselves either, right?
That's precisely right. And if you think about, incentives, drives, activity, and motivation. So if you think about where the alignment is, and you think about the incentives that can sometimes get misaligned in certain companies, when you've got your leaders of the company that are also big shareholders, everyone's working together. It's not about people in individual silos. Everyone's kind of rowing in the same direction. Doesn't mean we don't have, discussions about, specific strategies or kind of tactics, but ultimately everyone wants to see a public company succeed. And so everyone's well aligned.
I was really excited when I connected with you guys to be able to have you on the show because I think you're really unique because I feel like we live in a very kind of black and white society of like right now, everybody's either in AI or something physical. And I think you guys are in that unique sweet spot of you're actually trying to leverage technology along with the service part. How have you been able to blend that together and where do you think that'll go in the next, the next phase of this business?
Yeah, look, Kevin, that's a huge part of it. And I think we are a traditional economy business, but we're a business that has not really been disrupted or modernized in decades, frankly, and is still dominated by a fragmented group of service providers that operate with, 5, 10, 15 employees, and they invoice, maybe on paper or they invoice once a week when they're done their week. So being able to bring everyone together, get everyone on a centralized platform, use AI to our advantage. And we're really in the first inning of rolling that out, but it's something we're speaking about every day. We've got some really smart people around the company helping us deploy that technology. I think it's just a massive unlock in terms of how the service industry will mature. And really that comes down to more important than, the company's performance or reducing costs or being more efficient. It ultimately comes down to the customer experience because the company survives based on the customer. And so if the customer is getting a better experience, better data, better responses, then I think this company has a long runway to grow and succeed.
No, I definitely like this story. I'm really interested to follow you guys once you get that OTC ticker for the US. But looking through year end, like what do you think is the biggest fundamental driver of the company between now and year end?
Look, I would say it's a few things. We closed TFI in May. So you're going to see, TFI is going to have a tailwind behind it in terms of unlocking the growth on the equipment sales with our strong balance sheet and our strong relationships combined with theirs. So you're going to see the combined group continue to grow organically, probably quite aggressively in terms of unlocking the cross-selling. So the organic growth, the cross-selling, the integration of the platforms, buying, including the reverse takeover, go public, buying effectively 6 companies in 6 months is no small feat. So you're going to see the proper integration of those companies with the right people around it. And you're also going to see more acquisitions, certainly in the back half of the year. These ones have been more foundational, but you're going to see a lot of selective tuck-ins in key markets, adding service lines, maybe HVAC, locksmith, pest control, security solutions, and then adding regional coverage as we look to grow that internal technician base under our portfolio.
Well, thank you so much for coming on. For my viewers who want to find out more, where can they look up more about your company?
Yeah, sure. www.elevateservicegroup.com, and the ticker is SERV on the TSX Venture Exchange.
Okay. That's it for today. If you're watching on YouTube, please hit the subscribe button so you don't miss our next CEO deep dive. Paul, thank you so much for coming on.
Thank you, Kevin. Thanks for having me.